For the first time in the 111-year history of the Federal Reserve, a sitting governor has been fired. Nothing like this has ever happened before, and markets are stunned by the precedent being shattered. The balance of power over the U.S. dollar is quietly shifting in ways most people don't see yet. This unprecedented firing isn't just about one official. It signals a deeper transition in how money itself is managed. It comes as Chair Jerome Powell faces mounting controversy, and just as Congress hands the Treasury sweeping new powers over digital money with the so-called Big Beautiful Bill. Put those pieces together, and you can see it clearly. The Fed is being systematically weakened, while a new blockchain-based financial system rises under Treasury's oversight. The White House is openly pressing Fed leadership while floating replacements for the top job. At the same time, crypto dollars have been pulled inside the banking and national security perimeter. Treasury has just picked up the thickest set of keys it has ever held for the future of money. The immediate question is simple. Does a personnel purge plus a new law equal the end of the Fed and the birth of a crypto treasury? Not exactly, but it sets the stage for a policy knife fight over who runs the future dollar. And that fight matters to your mortgage, your savings, and the price you pay at the store. The move to fire a sitting Fed governor will likely be tested in court, but if it sticks, the calculus changes for every policymaker at the central bank. Independence works only when it's credible. Shake that belief and investors reprice dollar risk fast. The official in the crosshairs is Governor Lisa Cook. The president says he can remove her for cause, but Cook disputes it and refuses to resign, so the question heads to court. The White House, signaling a new chair, turns each policy speech into politics as much as economics. For years, crypto dollars lived in a gray zone where tokens grew faster than the rules. The new statute ends that ambiguity by forcing issuers under anti-money laundering rules, high-quality reserves, and supervision. It isn't a ban. It's a decision to domesticate the technology and plug it into the system under Treasury's line of sight. Stablecoin issuers now face bank-style compliance, reserves in cash and short treasuries, and strict oversight. The OCC will license federally approved non-banks. Bank regulators will police reserves, and Treasury now holds a master switch over illicit flows. But here's the piece almost no one is talking about. This isn't just about rules. It's about who gets to see every digital dollar move in real time. That's the kind of leverage governments dream about, and it's already being wired in. Now put the threads together. A White House trying to steer rates meets a Treasury with new authority over dollar tokens that move at internet speed. In a crisis, the player that can see the flows, freeze the pipes, or greenlight new rails doesn't just have leverage, they have power over survival itself. That's why some whisper about a hidden coup. Dramatic? Maybe. But ask yourself, who would you trust if the dollar you hold in your account suddenly flickered under someone else's control? But does that mean the Fed is being quietly dissolved? No. The Fed still sets interest rates, runs a lender of last resort, supervises banks, and operates core payment routes. What is changing is the perimeter around money itself. Stablecoins and tokenized deposits are turning dollars into software, and software money can be supervised at the protocol level in a way that old bank ledgers never were. Even so, the Fed is not a relic. In a panic, the institution that can create reserves still wins the day. What is new is that digital dollars and tokenized settlement let fiscal authorities see and influence flows in near real time. Here's a plausible transition. A regulated issuer launches a widely used dollar token with audited reserves and oversight. Cards, wallets, and exchanges plug in, while cross-border payments settle in seconds. Treasury polices abuse while the Fed modernizes wholesale settlement so banks move value instantly in the background. In that world, the balance of power shifts even if the org chart stays the same. Treasury sits closer to user-facing parts of digital money. The Fed focuses on rate policy, liquidity backstops, and bank risk. The public sees the dollar getting faster, programmable, and always on. Politicians see a new oversight stack where elected officials can claim more visible control over what people experience as money. If pressure on the Fed escalates and leadership churns, markets could lose faith that policy is anchored by data. That belief wobble could spike yields and force emergency actions. In that storm, a well-supervised stablecoin network looks attractive because it keeps payments moving when old pipes seize up. It has navigated inflation, banking scares, and ugly politics. But here's the twist almost no one expects. If governors start watching their colleagues get removed, they don't become bold. they freeze. And when the central bank hesitates, the entire market begins to write its own rules. Delay fuels volatility and calls to swap the institution for something modern. So what's the signal for investors and households? Focus on plumbing, not slogans. Watch 3 switches. First, who charters stablecoin issuers? Second, whether wholesale settlement adopts always on tokenized rails. And third, what courts say about presidential power to fire independent central bank officials. Those tell you who will steer the future dollar. If you run a business, prepare on 2 fronts. Also build a wallet strategy and stablecoin policy so you can accept, pay, or hold tokenized dollars the moment auditors and regulators are comfortable. Faster payment rails won't lower inflation, but they can cut fees and settlement headaches. A sturdier compliance perimeter makes scams harder and traceability higher, but the trade-off is more state visibility. Does any of this end the Fed forever? No. But it does end the idea that money lives only inside bank databases. It ushers in a hybrid model where monetary policy, fiscal oversight, and protocol rules share a stage. In that model, power is not abolished. It is redistributed across code and institutions, with Treasury closer to the screen and the Fed deeper in the engine room. Here's the bottom line of why the firing story matters. Personnel is policy. A fight over Fed independence plus a law putting digital dollars under a national security umbrella means the dollar's operating system is updating in real time. The issue isn't whether change is coming, it's who sets the defaults. Checklists map exposures to policy headlines, not vibes. Track which wallets your customers actually use. Mirror a slice of cash into tokenized treasuries or fully reserved tokens with audits. Keep durations short if political risk spikes, and make sure someone can read a balance sheet in a block explorer. Most channels will shout coup or crypto takes all by next week. The truth is sharper. The United States is pulling the useful parts of crypto into its legal perimeter while pushing back on pieces that threaten security. The goal isn't to kill the central bank, but to wire the dollar for the internet and keep it dominant. Let me end where we started. The headline about a fired governor is the opening shot in a larger contest over money, power, and code. If you understand how those pieces fit together, you will not be startled by the noise or dazzled by the hype. You will be positioned for the system that is already arriving quietly behind the outrage. If this helps you cut through the noise, hit subscribe now, because in the next episode, I'll reveal the exact playbook insiders are already using to move dollars at internet speed, and how you can position yourself before the rest of the world even knows it's happening.